It's the hard technologies that will relieve of the pressure from the US and from China. If we really want to reindustrialize Europe, so ensure that we set up our own energy production infrastructures, our own production infrastructures, and really build real resilience from the other regions in the world, it's Hardtech. It's Hardtech at its core, which means that the investors, the 92% of that money is flowing into doing new Spotify, so doing new fintech unicorns. And it's all great. I understand they get huge returns and it's a successful model. It's just not going to help us. And what we want to demonstrate at Nordic Alpha, and that's why we're giving everything away, is come play with us. Go take the education at the Danish Technology University. You'll learn the full playbook. You'll find out that what you consider extreme risk is actually ultra systematic. It's ultra mathematic. You can do it in a way where you can take these companies to this journey and you can exit them at huge multiples. And I think this is a big problem we have with the financial ecosystem. We need to consider this as a new asset class, and we need people to absorb that asset class as something they actually want to invest in. But many of them need to change their models if they want to do so. They cannot do the light approach to investing when you deal with the complexity of hyper transformation.
Yeah. Okay. Yeah. So essentially, it's not necessarily that those models are wrong in any way. That those models work well, but us as a society, if we as Europe, we want to push the boundaries, we need to invest in the other spaces, in a different strategy as well. That's really great. Thanks for that.
And maybe just
highlighting
in a very simple way. Sorry, Marcus, for interrupting.
Yeah, of course.
But if you are an early stage investor or a venture investor, and you invest in software, medtech, bioscience, any of these, you're going to invest, and you can premature scale these, give them full power, because eventually you're going to hit this level, and boom, hugely profitable.
Yeah.
Hardtech gets the opposite. The more you scale, the more your net working capital is going to kill you, because you're going to have a higher cost tie down with your business, and you will never hit this plateau. You might do some cost out, but there will be a direct correlation between your cost of scaling and the revenue forever, which means the DCF when you sell the companies are going to be terrible. So the future cash flow of a company that is doing, but the incremental or the marginal profit is 100% looks fantastic. But for a Hardtech company, it's terrible. So I really understand that this is a problem, that if we deploy that model, you're going to build assets that are not very attractive. And that is one of the things that I see in Europe. A lot of people talk about we have a scaling gap.
Yeah.
I believe we have a scaling chasm. We have a systematic problem with the way we perceive how we scale assets. Europe has 1/10 of the risk capital of the US. And if you really need to go to this premature scaling of assets, we're going to run out of capital, which means that if you really want to go to the other side of the chasm, so talking about Draghi's two gaps, where you have 53 trillion euros of established market. That's how big our established market across banks, pension funds, infracap, buyout, all these 53 trillion is waiting over there. But they will not touch stuff that is capital inefficient, which means that if we really want to scale companies that can move to that safe haven, we need to have a different approach, because the premature scaling is fine for the platform plays, but it won't work for your industrial hard tech assets.